Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Agti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
In this episode, Aaron and Trishul discuss market timing. Not necessarily for trying to identify highs and lows, but rather, after you have saved up some money and chosen an ideal investment, when do you put your money to work? This decision is rife with emotional ramifications, and you may be damned either way. They explain why goals and risk tolerance are an important part of timing your investment. In the end, a good, sound decision-making process can help you look back without regret, even though there may be no way to make you feel better in the moment. And now, onto our conversation.
Hi, my name is Aaron Agti. I'm a financial advisor in the Bay Area, and I'm here with Trishul Patel, a wealth manager on the East Coast.
Hi, Aaron. Great to be here today.
Great to be here as well. Today, we're going to be talking about the idea of market timing, and not so much of just picking highs and lows, but the idea that if you've already decided that you're going to invest, and you've even decided what you're going to invest in, whether it's an individual stock, an ETF, or mutual fund, you still have to make that decision of when to click buy. And that's ends up not being an easy decision to make. So we're going to go a little deeper today on some of the issues that come up that we've seen with clients when it comes to making those buys and sell decisions, not in terms of the investment, but in terms of the timing. So my first question to you, Trishul, is like, when I say market timing, what is the first thing that comes to mind for you?
With market timing, I think it comes down to this age-old question that you mentioned, and that's you have a bunch of money, you figured out that you want to put it to work in the markets, but you feel like you need to decide when is a good entry point. So I think when market timing comes up with traditional investing for average retirement accounts, for example, or savings accounts or investment accounts, that's what I think about. Finding an optimal entry point is the thing that goes through people's minds.
Okay, so I guess when I hear market timing, I usually think of buy low, sell high. And you have to choose when are you low and when are you high. But you're talking about the idea that it's not the buy low, sell high, or avoiding the opposite of buying high and selling low. You're talking about just the idea of I have cash that I want to invest. When do I put it in? Does that sound a little more accurate?
It does. So let me highlight that distinction a little bit more. When it comes to professional investing, you're spot on. That's what professional investors try to do. Really, if you think about investing in general, it's about answering two questions. First, what do you invest in? Second, when do you invest in it? That's all investing is. And when professionals try to do this, when they try to actively come up with a strategy that's designed to do better than a passive approach of just investing in an index and forgetting about it, what they're really trying to do is time their investment decisions. They're trying to come up with a good entry point and a good exit point, and they're trying to buy low and sell high. You're right. That's exactly right from a professional standpoint. And a lot of people try to do this in their own investment accounts as well, if they're trading stocks, for example. But typically, if somebody is just looking to put their money to work in the markets, I think the primary question that goes through their minds is, okay, I have the money, but now when should I put it to work? And I think that when question comes up because there's two scenarios that tend to play out. First is people look at the stock market and they try to gauge where it is and they try to get some comfort level on how they feel about what's going to happen in the future. And what they see some of the time is that the market seems to have been doing really well, and that makes them nervous. It's that whole angst thing coming up again. Because they think, oh boy, if I get in now and the market turns south, I am not going to feel so good about myself. But the second thing that happens is if the markets aren't doing so great, if it's been a little bit turbulent or a lot of bit turbulent, then people think, oh boy, I don't want to go in now either. What if it goes down from here? And so these concerns ruminate within one's mind until the point where they end up, unfortunately, in fact, not putting the money to work in the market and letting it sit in the sidelines, which we can explore a little bit later in this episode on why that's not ideal.
So two cliches come to mind. One is the damned if you do, damned if you don't. Like you're going to feel the angst either way. The other is it's like a classic financial advisor cliche. It's all about time in the market, not timing the market. And I'd never really liked that cliche, but it sounds like exactly what you're talking about. It's that the biggest kind of cost or opportunity cost is not putting the money in and watching it drop, or watching it drop and not putting the money in. It's just the idea that, like, just not putting the money in is the biggest realistic risk that most people take on. Does that sound like an accurate description?
It most certainly does. And I've kind of looked at this from a few different perspectives. For example, if you even model what happens with 2017, market's up a good amount over the course of the year. 2017, it was up about 20%. And if you had sat on the sidelines at the beginning of January because you were concerned about a potential fall because things were looking too good or things were looking shaky, you would have missed out on a good 20% return. And
I made similar observations where, even going back to like 2013, I think 2013 was the first huge single calendar year after 2009. Like there was some recovery, but that was just an absolute huge year. And in end of 2013, looking into 2014, people were like, oh man, the market's way too high. We just saw this huge recovery. It's bound to kind of drop down. And all we've seen is another 6 years of growth.
Right. It's amazing. And if you had just sat out one of those years, let's take 2017, for example, when it was up around 21, 22%, that means over the following 10 years, you would have to beat the market by over 2% a year to catch up. And in our industry, we know very well that's next to impossible. So what you basically did is put yourself in a hole that even if you were one of the best investors out there, you will not likely climb out of.
Yeah, and so I think that's part of what I end up helping clients with, is just understanding that we're not trying to make a timing decision based on the market being high or low at that point. It really is, what is the purpose for this money? What are your lifetime goals? And making the investment decisions based on that. So if they're investing in stocks, one, we kind of, for retirement money, this is money that we know we need. So we're not doing individual stocks. That's based on our buying stocks for fun episode. But this is going to be a diversified portfolio, very aggressive, still could be 100% stocks depending on their age and risk tolerance. But it's the idea that we're going to leave this here for 20 plus years. We're not going to touch it for at least a couple decades. It kind of doesn't matter what happens in the next 6 months. And so if we ended up buying at a market high and saw a big drop, that's fine, because we're not going to touch it for 20 years. But if those drops in those first 6 months concern you, not because of emotions, well, we'll get to that, but just the idea, you need this money sooner, then you shouldn't be in stocks in the first place. You should be using a combination of cash and or bonds. And it's that alignment of what is the purpose for the money with the investment decision that theoretically removes a lot of the timing concerns. And I'm wondering if you've been able to help your clients with that as well. Just why are you afraid to make that buy decision? Why are you afraid to say, yes, let's move forward now? I'm curious, what have you observed with your clients?
Right. The biggest fear is, again, putting that money to work and watching it fall. So with investing, it's great to follow a process that tries to strip out the emotions. And what I try to do is go through the steps of the process to show people how we get from A to Z. So the first step in the process is first to think about a timeline that you want to invest this money for. What is this money used for? Is it a short-term goal, saving for a down payment? Or is it a long-term goal, saving for retirement? Once somebody understands that, then we can think about an individual's risk profile. How used to or how common is risk for this person, and how much are they able to tolerate? So even though somebody has a long investment horizon, they may not like the idea of that money going down 50%. So from that perspective, even if we can help educate the client that over that time period, over a 20, 30-year prime period, the chance of being down 50% is low, even though it may dip below 50% for a certain window within that period. But even so, some people may be reluctant, in which case we would lower the exposure to the markets for that particular individual.
Mm-hmm.
And once we align those objectives, then we come up with a set of instruments. Then we try to answer those questions on what to invest. And when you try to understand what to invest in, what you're really doing is you're making a strategic decision, a long-term decision on choosing things that are going to be around for a while. And from my perspective, I like to recommend a globally diversified portfolio of stocks and bonds, because I hope the world is going to be around. And if it's not, then we're in bigger trouble than picking a portfolio.
It sounds like trying to explain why treasuries are fine compared to like FDIC insurance, that if something goes wrong with the treasuries, there's so many other things going on that your investment in treasuries is not your biggest concern.
Right. So once we figured out that, then the next question is timing. And for that, it's the last question. And there are really a few options. The three big options that you hear are just put it all in and come back in a couple of decades. It's retirement money. The other common thing you hear is let's dollar cost average. And I'll talk about that in a bit. And the third thing we hear is let's try to tactically time this investment and look for a great entry point. Now, I think the tactical timing aspect is probably the worst thing you could do. And there's plenty of research to back this up. There's even research looking at professionals who try to do this, and they just don't fare so well. For example, Morningstar looked at these types of strategies from professionals, and they looked at how these actively managed portfolios who moved in and out of the market did from a decade of history. This one was from 2004 to 14, and these individuals underperformed by about 1.5% than individuals or professionals who just said, I'm going to stick it in the market and not try to time when to get in and out. 1.5% a year can strip away a good percentage of your wealth over a lifetime. I'm not sure people really realize that, but it's that important to not give that amount up. So now we're down to the two choices that I mentioned initially. One is, do you put it all in or do you dollar cost average? And both seem about the same, but there's some research that shows that if you put it all in, you'll likely do a little bit better.
I've seen similar results, and I try to tell clients that from a pure numbers standpoint, the market is more likely to be up over the next few whatever time frame you pick. The market is more likely to be up than down, and so since we can't predict the future, the probabilities are just put it all in. It's more likely to be up, and if you're going to dollar cost average, you're more likely to be buying slightly higher in each subsequent time period than you are if you just put it all in at once. And my personal experience with this, it kind of both on the emotion side and the actual numbers side, dollar cost averaging, just the idea of splitting a investment purchase over a few time periods. Could be over 3 months, could be over a full year, but just this idea of not putting it all in one single time period ends up kind of as an emotional hedge. There's no real numbers to support it, but it does make clients feel a little more comfortable with the idea of that worst case scenario of putting it all in and then just watching it drop. And I actually experienced this. And I have a story that relates to both of these. I was sitting in cash from 2013 to 2016. I had a relatively large chunk of money during what we had mentioned earlier was some pretty big returns in the market. But this was because my wife and I were looking for a house. We live in the Bay Area. Housing was very difficult to find. We placed, I think, 10 offers on different houses over these 3 years and kept getting turned down, kept getting outbid. But because we knew we needed this money as a down payment on a house, it sat in cash for 3 years. When we finally found our current house, we had some of that cash left over. We didn't use all of it. And so I put it all in and I followed the research. I knew, like, you know what, I'm not going to dollar cost average, just going to pick a day. This ended up being the day before the Brexit vote. And the day of the Brexit vote, the market dropped. I think it was 6% in a single day. And it's like, I just experienced kind of like the worst case scenario. If you were to pick sat in cash while the market went up, invest cash all at once on that certain day and watch it drop dramatically the next day. Like, I remember even checking, did the transaction go through the day before, or did like just custodian processing meant, it didn't get the actual mutual fund purchase, what didn't happen the day after? It's like, no, it purchased exactly the day before. So I watched my money drop 6% in a single day. And if I had dollar cost averaged, because based on my story, that's what you think, you should have dollar cost average, because you saw kind of that worst case scenario. The first day you were invested, it dropped by a ton. But it actually bounced up pretty quickly. And if I had done a dollar cost average, the next month, it was already higher than my original investment. I would have already lost a little bit of that opportunity cost, that 1.5% per year you're talking about, if I had left it in cash and waited a few months. And it actually went up the following few months as well. And it doesn't make it any easier. It's kind of, it's hard to go through. I can feel it. I do this for a living, and I know what I'm doing. But both that seeing the market go up while I was sitting in cash, then investing, seeing it down, like, it didn't feel good. But at each point, I felt okay because I knew why I was making those decisions. I felt confident in my decision-making process that I'm not going to invest the money I have as a down payment on a house in stocks. I can't take the risk of seeing it down. I left it in cash for 3 years and just watched the opportunity costs go away. And actually, I even kind of sold some prior to 2013 to raise the money to be a down payment house. I had sold some investments because I knew this was time to start sitting in cash, and I'm okay with that. Like, I never felt overwhelming that angst, I guess I'd say. If I felt bad or unlucky, I guess I'd say. It's like, that kind of sucked. But I didn't feel like I regretted my decision because I had that decision-making process in place. And so even though I did miss out on the upturn and saw it drop the first day I was invested, I still knew I made the right decision every step along the way, knowing that we can't predict the future. And I share this story with clients, and I try to ask them to kind of think about, how would you feel in each of those scenarios where you're in cash while the market's going up, or you invest and it drops down? And it almost always comes back to trying to remember what the purpose of the money is. Because it's just as likely that the opposite happens. That if you invest it, or I don't say it's just as likely, but it's a very realistic possibility that, okay, this is money as a down payment on a house. I think the market's going up, and it goes down, and now it means you don't get the house. Now you've dramatically changed your life goals based on external events. And that's where the pain point comes in. And investing the day before the Brexit vote, this was now money is going to be retirement. It's like I had my down payment on my house. This is now long-term retirement dollars. The Brexit vote doesn't matter, but if I wait and leave it in cash, kind of like what you're talking about, looking for that time period and try to find that right moment, and I give up on 20% return over the next few years, that's what's going to impact my long-term goals, not the 6% in a single day. And so I'm curious, what are some of the experiences that you've had, whether it's on the success side or on the failure side, of trying to keep that decision-making process in mind when it comes to timing, and how you have kind of felt about that? How have you handled your emotions when it comes to some of those failures?
Well, first of all, I like that story you put out there, basically showing that even if we understand intellectually how we should be conducting ourselves with the markets, just emotionally, it's just not that easy. So I'm glad that you shared that. And we all experience these types of behavioral concerns where even if we know what is best, it's really challenging to follow that path, especially when you're under a hail of fire of red numbers in the market. I've certainly felt that way as a portfolio manager, where I have tens of millions of dollars at stake, and all of a sudden we need to make a decision where, for example, at the time, every time a tweet would come out from Trump, it would send us flying left and right, especially if it involved North Korea and some sort of missile that they launched. I remember we'd have conversations at 4 a.m. at night after some sort of ballistic missile firing out of the South Asia Sea, where we're trying to figure out, okay, well, do we pull all the money out and sit on the sidelines? Is there a nuclear warhead on that missile? And do we need to take some sort of evasive action? What will our investors say? And what I always try to do under these scenarios is come back to, what do we know? What can we do about it? What do we don't know? And really try to trust the information that we have. Because when it comes to the markets, there will be bad days. You can't stop that. The market will go down. But what you can rely on is your analysis. And that's what I always had to point to, the fact that we had done our research, we had come up with something logical, we've looked at data going back decades, and in all of those days, we did not need to do X, Y, and Z, so why would we need to do it now? And for this specific scenario, when it comes to managing retail clients and coming up with a strategy that makes sense, I really like to show clients just what the data says so they have a good understanding. For example, I've looked at every rolling period of the S&P. You can actually extrapolate it back to the 1800s, late 1800s, using extrapolated data, and looked at every rolling 5 years, every rolling 15 years, and so on, and to see what are these worst case scenarios that people are so concerned about. So if you look at it, the very worst that the S&P has done over a rolling 15-year basis after adjusting for inflation.
Sorry, you said 15 years or 5 years?
Yeah, we can start with 5. The very worst that happened in a rolling 5-year basis is being down 13% annualized.
Okay.
Now, it's not great, but what that typically means is you probably need a longer investment horizon than 5 years. But on the 15-year side, that negative 13 annualized return goes to a negative 2% annualized return, inflation adjusted.
Oh,
Meaning,
inflation adjusted. So you're even
yeah,
slightly positive.
meaning, yeah, if you don't factor in inflation, you're actually up a little bit. But factoring in inflation, the worst case, rolling 15 years over this 150-year period, is you're down on average 2% a year.
Okay.
On the 25-year standpoint, this is now retirement money we're talking about, the worst case is you're up 2% inflation adjustment. Meaning,
So
if you're
25 years, there's no rolling period that you've been down, even at like even with inflation adjustments.
exactly, you're
Okay.
up all that time. And these are worst case scenarios, meaning the absolute worst. What I encourage people to think about is probably think about the bottom 10% of cases and think about that. Meaning 90% of the time you're going to be better off. Those same numbers for a 5-year period, instead of being down 13% annualized inflation adjusted, you're only down 3%. And on the 15-year side, 90% of the time you'll have earned more than 1.5% a year inflation adjusted.
Okay.
And that 25-year retirement period for investing, you'd be up about 4% inflation adjustment 90% of the time.
So that's probably on the scale of like 7-8% when you take out inflation. So like 7-8% nominal rates of returns, and then 4 to 5% inflation adjusted returns on a 25-year period.
In terms of, yeah, better 90% of the time, yeah.
Okay.
Now, on average, you're far better. I'm talking about
Okay.
the worst case. On average, you're up 7%. We've
A
talked
realistic
about this a few times.
bad scenario that's not quite the
Right.
worst case ever.
Exactly. So if we want to calibrate our expectations, it's worthwhile looking at these fears that people have of the market being down 50%, because those numbers get washed away when you look at a 15, 25-year time period, which is what you're doing when you're investing for retirement.
So I do like this, and I try to apply similar thought process. I don't have quite the same level of rolling returns that you're talking about, although understanding how those rolling returns impact safe withdrawal rate research is very important. But when it comes to doing financial planning and long-term projections for clients, I do tell them there's a difference between these kind of long-term possible returns and short-term randomness. So in doing planning, I think that there is some capability of a little bit of predictability in terms of future returns on stock markets bonds based on valuations. And very, very roughly, if we're at all-time highs and we've seen really high returns, then it makes sense that just with basic reversion to the mean, over the next 10 or 15 years, we'd probably expect the stock market to be below its long-term historical average. It's still probably above that worst case, or even that 90% worst case number that you're talking about. But it would not surprise me if long-term returns are below the long-term historical average. Let's say if the S&P 500 has a historical average on the scale of 10 or 11%, then if we only got 6 to 8% over the next 10 years, that would not surprise me at all. And these are nominal, not inflation adjusted. But I also point out to clients that in the short term, we cannot predict how this is going to happen. And this comes up over and over again. I think the first book that talked about this was called A Random Walk Down Wall Street. But there's no predictability for what's going to happen over the next 6 to 12 months, and even maybe probably on the scale of 2 years. And so I try to paint stories of, that's a weird metaphor, painting stories. Try to tell stories or paint pictures of how do we get to those below average returns. It could be that we just muddle along at 5 to 7% every year. And it's like, it doesn't feel good or bad. It's just kind of like this frustrating, nothing's happening. That's a realistic possibility. It's also possible that we could see a crash. A crash is realistically possible, that we see a -20 or -30 in the next couple of years, and then we start climbing out of that over the following 8 to 10 years. It's also possible that we go up another 20% before we see those downturns to get back to the longer term expectations. And the reason this is important is that if we're making an investment decision now, even if we expect below average returns and we'll plan around that, we still have no idea what's going to happen over the next year. And so we can't try to time our investment decisions based on those long-term expectations. We have no idea if it's going to go up 20 or down 20. And if we have that long-term goal, we do need to be invested now. That we can't take the risk of missing out on that plus 20. And even if we got that negative 20 in the first year, we have enough time to recover. And like you pointed with the rolling periods, it likely will. We do see that reversion to the mean pretty consistently over a long enough time frame.
That's a very thoughtful approach. That makes sense. That makes a lot of sense to me, Aaron.
So I'm curious, when you do planning for clients, do you discuss anything similar? Like when you're actually sitting down with a client and saying, okay, here's my money to invest. What are some of the conversations that you have experienced that come out from these conversations?
Well, first, what I like to do is do a risk assessment with the client, meaning I want to get a pulse on where they stand in terms of their risk tolerance. And there are various questionnaires out there. And what they basically do is ask a client in terms of how would they feel if the market went down X amount, and would they be able to sleep at night if X, Y, and Z happened, and so on. And what this helps us understand is, okay, this individual, it has a lot of risk tolerance. They feel like this individual can handle a lot of exposure to the markets, which is great. And we'll go down one line of thinking with that person. And there may be another client where their risk preference is low or their risk tolerance is low. And that's not necessarily a problem unless that client simply won't be able to retire if they keep all of their money parked in low risk investments. You can't really have money work for you if you don't put it to work. So with those clients, the goal isn't necessarily to inundate them with thousands of research papers and point to X, Y, and Z charts. That won't work at all. But the goal is to just have a conversation to kind of nudge them in the right direction. Just make little steps that can help improve. For example, if they're all in cash, at least let's try to go, for this quarter, let's try to get things into some type of bond portfolio that might be sensible, that matches their duration. And then from there, we can dabble with putting some equity exposure into the pie and saying, look, this equity exposure is in there. And we realize that, the market can go down 50%, but it's only 10% of your portfolio, meaning 5% for you.
Yeah.
And what people need to realize is just because one of their positions within a portfolio goes down X amount doesn't mean they've gone down X amount. Portfolios are designed to be thought of as a whole rather than as a piece when you look at overall performance. And that's what we try to hinge on when we're looking at these types of conversations with clients.
I like the idea, and the risk tolerance is important, especially when it comes to how clients feel. I have had a few situations where even though they're 20 years from retirement, they would not feel comfortable. They would not be happy. They would lose sleep at night if they saw their portfolio go down 50%. And so the conversation then becomes, okay, if we're not going to get equity-like returns over the next couple decades, we can make a more conservative portfolio, but the implication is that you have to save more to reach those future goals or plan on retiring later. There are other ways to plan around that, but you're right. I have had a few times where even though the time frame might be appropriate, their actual comfort level does not line up with that. And it's does sometimes it's we can't get too conservative for the same reason. Like just you have to make sure you at least outpace inflation over the next couple decades. We can't be losing money, and that just might require some risk, just even if it's just in conservative bonds. But making sure we are focused on how clients feel about their investment decisions is pretty important.
Yeah, that certainly makes a lot of sense to me.
And then I like the other point of just sometimes we pointing out that diversified asset allocation is incredibly important. It's always the first part of any investment conversation I have with clients, kind of focusing on diversified asset allocation. But then every question I get in the future is, here's what happened to the US stock market based on the news I saw today. How does this affect my money? And sometimes it's, well, you're mostly in bonds. And on the stock side, we have a pretty good short cap, small cap, and international emerging markets exposure. So yes, the 10 to 15% of your portfolio that is in the US large cap stock market did go down today, and it's gone down the last week, but your overall portfolio did not. Your overall portfolio, that's just, it's a smaller amount of your overall investments. Then that's why we went with the diversified asset allocation in the first place.
Yeah, that's a great approach. And I think it's important for our clients to realize that there's been a lot of research on these topics in academia, and then there's been a lot of products created on Wall Street. And over the past decades, we've come to a pretty good understanding on what works and what doesn't. And it'd be far-fetched to find an advisor who would say a diversified portfolio is not the way to go.
Unfortunately, I do know a couple who kind of they tend to be older, but they've built their value proposition around, here's my 30 stocks that I know really well. They
Right.
don't do much else. They don't do any kind of planning, but unfortunately, that still exists.
I'm sure it does. I think this study may have come up before, but we have looked at, now there's plenty of data to look at how these types of strategies where people try to pick stocks work over long periods of time. And the data just continues to validate the notion that it's a losing proposition.
Um, I disagree with that slightly. From what I've seen, it's not a losing proposition. It's just really, really hard to win. You might come out the same. I think the most likely scenario is that you're going to come out the same after fees, and that those who do outperform can't. It's hard to find the manager who's going to outperform over the next time period, and there's not as much predictive value there.
I think this is certainly a bigger conversation that we will definitely have to dive into.
Okay. Well, we'll save, because I guess I'm not a true proponent of active management, but I'm not an opponent of it either. I think that it is possible, but really, really difficult and harder to implement in real life. But you're right. That is a deeper conversation for another episode.
I look forward to that one too.
Okay. So anything else on kind of wrapping up with the idea of emotions related to going from cash to making an investment? Anything that you've seen on kind of getting out of the market, or any final thoughts?
Sure. I'd just like to sum up a few things. So we looked at the notion that if you have a good amount of money already and you need to put it to work, that lump sum is just, mathematically, it seems to be the best approach based upon history. But dollar cost averaging is still pretty good, much better than trying to time. I think that's the main point. At least I'm trying to drive home here in terms of what somebody should do. But I also want to point out, if you don't have the money right now, meaning you're getting a paycheck and you want to put money to work, dollar cost averaging is absolutely a great way to go about it.
Mm-hmm.
Just it pulls out the emotion. Even better, have the money go directly from your paycheck to your investment account. It's not hard to set up, and that way you don't have to think about it, and the money gets to work as soon as you get it. So you reduce that opportunity cost drag of having to build up a bunch and then think about when you're going to put it in the market.
I love that. I completely agree. And investing in their company's 401k tends to be one of the overwhelming recommendations I make to clients. It's easy. It works. It removes a lot of the little inefficiencies, removes a lot of the kind of emotion and kind of concern regarding making decisions, and it just ends up helping people to get to their goals.
Yep, absolutely. So I think that's a good point to end on.
Okay. So thank you very much for our discussion on market timing, and just keep saving and investing, and then don't look at it for 10 years.
Yeah, I think I said this before. Just throw away that login and password and make sure the statements go to some other place but your home, and come back in a couple of decades.
Okay. Well, thank you very much for the conversation today, Trishul. I really enjoyed it.
Thanks, Aaron. I had a lot of fun too. And I want to thank all our listeners as well for tuning in on this one. We appreciate you coming to hear about us. And of course, if you like what you hear, do subscribe to our podcast on a go-forward basis.
Thank you. Have a nice day.
Okay, bye.
Bye. We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.